3 to 5% is not the standard for down payments in real estate. So let's talk about what nobody tells you about when they're selling you on home ownership. And it's called PMI, which is private mortgage insurance. And if you don't know what it is, then this video right here could save you tens of thousands of dollars. And here's how it works. See, when you buy a home and put less than 20% down, your lender sees you as a high-risk borrower. So they make you pay for an insurance policy that protects them, right? Not you. And that's just in case you default on a loan. So let me say that again. You pay the premium. The bank collects the benefit. You are literally paying to protect the bank's investment with your own money every single month. So now let's talk about what this actually costs you. On a $400,000 home, PMI typically runs between 0.5% and 1.5% of the entire loan amount per year. So on a $320,000 loan, that's after your 5% down payment of $20,000, you're paying somewhere between $133 and $400 extra dollars a month on top of your mortgage payment, your property taxes, your homeowner's insurance. So let's use the middle and we'll call it $200 a month. That's $2,400 a year. And here's the part that should make you sick. You don't just pay for a year or two. You pay that PMI until you reach 20% equity in your home, which at today's prices and a 5% down starting point could take you 8 to 11 years, depending on your market and how fast your home appreciates. So let's run the real number. $200 a month for 10 years, that's $24,000 in PMI payments alone. On top of a mortgage that you're already paying, on top of property taxes, on top of insurance, on top of maintenance. And that $24,000 built zero equity. It went straight to the bank's insurance company and it got you nothing. And here's where it gets worse. That same $200 a month invested in the S&P 500 over 10 years at 10%, that annual average return would have grown to approximately $38,000. So the PMI doesn't just cost you $24,000, it costs you $38,000 in opportunity cost, because that money could have been working for you in the market instead of protecting the bank. So if you ain't got 20,000 to put down, if you ain't got 20% to put down on a home, don't even buy one, because you're just getting fucked harder. And if you want to learn more about money, how to get money, hit the link in my bio.